Hi guys, it's Doc Curry, and the bond market just flashed the biggest recession warning in over 40 years. It has not been this bad since the Black Monday crash of 1987. I'm going to tell you what's going on, so let's get into it. Before we get to the bond markets, let's start with some stock market news that came out today. Private payrolls rose by 242,000 in February, which was more than expected. After January's hotter than expected jobs data, it looks like February's job data might also be higher than expected. Keep in mind that Jerome Powell has stated over the past 2 days that the strong labor market is a concern to him, and it's one of the reasons that they are going to continue to raise interest rates, because if the job market remains strong, this could cause inflation to come back. Now, even though the total number of job openings declined slightly in January over December, there still remains 1.9 job openings per available worker, so the labor market remains extremely strong. Don't forget that the official jobs data comes out on Friday, and that is going to be another massive market mover. In the housing market, mortgage demand has recovered slightly despite rising interest rates. Total mortgage application volume rose 7.4%, while applications to refinance a home jumped 9%. It should be noted, however, that this is a seasonality thing as we approach the very busy spring buying season in the home market. So it makes sense that mortgage demand would start to increase as we approach the spring buying season. Now moving on to the bond market, a key recession indicator just sent investors the sharpest warning in 42 years. The 10-year and 2-year yield inversion curve is now at -1. That's a 1% difference between the 2-year and 10-year treasury yields. It has not been that low since the 1980s, when we got 2 recessions back to back. That was also the decade that Black Monday occurred, which, as you can see on the chart, was one of the largest drops in the stock market in history. The Dow Jones dropped 22% in one day. It was the largest single-day decline in the history of the stock market. And the bond market is screaming that this could happen again. Now, we do have circuit breakers and limits put in place in the stock market, so we will never have another 22% decline in a single day in the stock market ever again. But a 7 or 8% single day decline is very possible, and a 22% decline over the course of, say, a week is also very possible. And this is some of the fears that the bond market is saying, hey, stock market, watch out, because we are about to get a really big recession. Meanwhile, the stock market completely ignores all of the warnings from both the bond market as well as the Federal Reserve, but they better start paying attention because the Fed's next meeting is coming up in less than 2 weeks. And BlackRock says the Federal Reserve could hike interest rates to a peak of 6% and then keep it there for an extended period. Jerome Powell says that the data will determine the size of the next rate increase. Specifically, Jerome Powell is talking about the jobs data coming out on Friday and the CPI report coming out next week. Despite that data not being released yet, based upon the hawkish statements from Jerome Powell over the past 2 days, the CME futures are now pricing in an 80% chance of a 50 basis point rate hike and only a 20% chance of a 25 basis point rate hike. Again, it is the bond market that is pricing this in, not the stock market. The stock market is still trading as if the Fed were going to stop raising interest rates and even cut them by the end of the year. The bond market has a very different outlook for the Federal Reserve. Ultimately, who is correct? Well, time will tell. And you may say, well, Scott, the stock market trades on earnings, not yields on the treasury rates. Well, don't forget that those higher yields are a result of high inflation, and this ultimately results in lower earnings. Adidas warns of the first annual loss in 31 years and cuts their dividend. And it's not just Adidas. With Q4 2022 pretty much over, with 99% of S&P 500 companies reporting results, the blended earnings decline for the S&P 500 is 4.6%. The fourth quarter will mark the first time the index has reported a year-over-year decline in earnings since Q3 of 2020. And it's not going to get any better anytime soon. For Q1 of 2023, 81 S&P 500 companies have issued negative earnings per share guidance, with only 24 issuing positive earnings per share guidance. That's right, 75% of S&P 500 companies said earnings will be worse in Q1 than they were in Q4. Now, despite all of this negativity around earnings and yields, the fact is there are still some stocks that remain undervalued that are great buys right now. Warren Buffett's Berkshire Hathaway buys more Occidental Petroleum shares. For those of you who are subscribers to this channel, you know that I also bought more Occidental Petroleum shares on Friday. If you want to know everything I'm buying, I post my buys in the Millionaire Club portfolio. It's completely free, and everything is posted right here on YouTube, as well as Rumble and a few other platforms. If you want to see the full portfolio and every single buy we make, just subscribe to this channel, click the bell icon, turn on alerts so that you will know when I make buys in the portfolio. If you want to watch the past videos, you can go to the Millionaire Club playlist that is posted on the homepage of this channel. And now moving on to crypto. Crypto remains quite bullish over the past few months, despite numerous bad announcements, including Grayscale shutting down and now Silvergate shutting down operations and liquidating their bank as well. Like the stock market, crypto's remained resilient in the face of extremely bad news over the past few weeks and months. But ultimately, the question is, will the bullish technicals or will the bearish fundamentals ultimately win out in the end? In my experience, with over 20 years of trading, the technicals always fall in line with the fundamentals eventually. The only problem is timing that is nearly impossible. Now, if you want to make money with us as we trade in this very volatile market, we are making quite a bit of money over in our We Profit Day and Night coaching program. Sweet Cheeks made a 239% profit on an OXY call. And Yo-Yo Jomo has been consistently profitable with a massive winning streak just by following the plays of our coaches. If you want to get in on these trades also and follow along and learn how to trade options and make money no matter whether the market goes up, down, or even trades sideways, come join us in the We Profit Day and Night coaching program. You can get more information about that at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading. If you missed the last video where I talked about Jerome Powell's speech from Monday, or Tuesday rather, where he gave some great testimony with the Senate, and he gave some very hawkish statements, which have some really big red flags for the stock market, make sure you go watch the last video that I uploaded here.